I've spent decades watching markets move, crash, recover, and reinvent themselves. I've seen bubbles inflate, and I've seen narratives collapse overnight. But what's happening right now doesn't look like a simple correction. It looks like a disconnect between what people are being told and what the underlying reality actually suggests. Every headline says the AI boom is overheating. Analysts warn about stretched valuations. Commentators repeat the same message that the rally has gone too far and a major reset is inevitable. And yet, when you step away from the noise and look at capital flows, corporate commitments, and policy direction, a very different story begins to emerge. One that isn't built on hype, but on structural change. The real danger isn't volatility itself. The real danger is reacting to a narrative that might be designed to make you step aside. Right before the next phase of growth unfolds, today's trending topic is the so-called AI bubble, and the world is being conditioned to believe that the boom has already peaked. But the deeper question is this truly a bubble nearing collapse? Or is it a strategic narrative shaping investor behavior while long-term positioning quietly continues in the background? Let's begin with the dominant narrative. The media is warning that AI-related stocks have run too far too fast. Pundits argue that retail enthusiasm pushed valuations to irrational levels and that the recent volatility proves the market is correcting excess speculation. Social platforms are full of cautionary voices predicting an inevitable downturn. When a single message echoes everywhere, it naturally triggers fear. Investors start to question their timing, their conviction, and their risk tolerance. They begin to feel that perhaps they arrived late to the trend and that the safest move now is to step back. This psychological shift is powerful because markets are not driven purely by data, but by perception. Once doubt spreads, even strong positions begin to look fragile. That is often the exact moment when the most important positioning decisions are being made behind the scenes. Now step away from the narrative and examine the structural reality. Over the past months, capital allocation toward artificial intelligence infrastructure has not slowed down. On the contrary, it has accelerated. Cloud providers are expanding data centers at an unprecedented pace. Semiconductor manufacturers are investing heavily in next-generation chip fabrication. Enterprises across industries are integrating AI into their operational workflows, not as an experiment, but as a permanent shift in how business will function going forward. Governments are treating AI as a strategic priority, embedding it into national competitiveness frameworks. These are not the actions of actors chasing a temporary trend. These are long-term commitments that signal belief in sustained demand. When institutions deploy capital on multi-year horizons, they are not reacting to short-term market hype. They are positioning for structural transformation. Another important layer to consider is market mechanics. During strong rallies, liquidity, conditions often tighten, financing costs rise, leverage becomes more expensive, and volatility increases sharply. On the surface, it appears that the market is naturally correcting after overheating. But in many cycles, this tightening serves a secondary function. It forces leveraged participants to exit positions they would otherwise hold. When margin pressure increases, positions are liquidated not because conviction changed, but because capital requirements suddenly become harder to meet. This forced unwinding creates cascades of selling that look organic but are actually mechanical. The narrative then frames the move as proof that the rally was unsustainable. Yet the underlying demand drivers may remain completely intact from a historical perspective. This pattern has repeated across multiple technological revolutions. Early phases are marked by explosive growth, followed by sharp volatility that convinces many participants that the story is over. However, if the underlying technology continues to reshape industries, the long-term trajectory eventually resumes. What changes is not the structural direction, but the ownership base. Weak hands exit during volatility, while patient capital accumulates. Over time, the narrative catches up to the structural reality, but by then, the positioning advantage has already shifted. Consider the behavior of large corporations during this period. Public statements often emphasize caution, highlighting risks and uncertainties associated with rapid technological change. Yet at the same time, internal budgets dedicated to AI development, automation, and data infrastructure continue to expand. Hiring in specialized AI roles remains strong. Research partnerships and long-term supply agreements are being signed quietly rather than announced loudly. This duality is not accidental. Public caution manages expectations and reduces speculative frenzy, while private investment secures future competitive advantage. Retail investors hear the caution and assume institutions are stepping back, when in fact the opposite may be happening beneath the surface. Psychology plays a central role here. The human mind reacts more strongly to warnings than to gradual, positive signals. Fear is immediate and emotional, while structural transformation is slow and analytical. As warnings about a potential bubble intensify, investors begin to frame every price dip as confirmation that the thesis is breaking down. They shift from conviction to defensiveness, prioritizing capital preservation over participation. This defensive stance often emerges precisely when long-term capital is most willing to step in, because volatility provides more attractive entry conditions for those who believe in the structural story. The broader strategic landscape also reinforces the long-term case. Global competition around artificial intelligence is intensifying. Nations are racing to secure technological leadership, not only for economic reasons, but for geopolitical influence. This competition ensures sustained investment regardless of short-term market sentiment. Companies cannot afford to pause development simply because stock prices fluctuate. Falling behind in technological capability carries a far greater cost than enduring temporary valuation swings. As a result, real-world adoption continues to expand even when market narratives turn skeptical. Looking ahead, several scenarios are possible, but they share a common foundation. If adoption progresses steadily, current investments gradually translate into measurable productivity gains and revenue growth. If adoption accelerates faster than expected, the perceived overvaluation narrative could quickly reverse as earnings begin to justify earlier optimism. Even in a slower adoption environment, the direction of change remains forward, not backward. Technological integration, once embedded into business models, rarely gets undone. It evolves, scales, and becomes indispensable. The speed may fluctuate, but the structural path tends to remain intact. One of the biggest risks investors face is confusing volatility with invalidation. Short-term price swings often reflect liquidity dynamics and sentiment shifts rather than fundamental deterioration. When narratives emphasize risk repeatedly, they can overshadow the deeper signals that point to ongoing transformation. Investors who react solely to the loudest voices may miss the quieter but more consequential developments shaping future markets. Over time, the cost of missing structural trends tends to outweigh the discomfort of enduring temporary drawdowns. Strategically, informed participants focus less on daily price movements and more on long-term alignment between capital flows, corporate strategy, and policy direction. When these three forces move in the same direction, they create a powerful tailwind that short-term sentiment struggles to derail. The challenge is that retail investors often observe only the most visible layer of information, which is the price narrative. Institutions, on the other hand, monitor positioning, investment pipelines, and technological milestones that signal where future value creation is likely to occur. This informational asymmetry leads to very different decision-making frameworks. At its core, the current environment is not simply about whether prices go up or down in the near term. It is about whether a transformative technology is fundamentally altering how economies operate. If that transformation is real, then temporary corrections become part of the journey rather than evidence of failure. The real question becomes whether one chooses to interpret volatility as a warning sign or as a feature of an evolving market adjusting to a new paradigm. So the decision facing investors is not just about timing determines who participates in, but about choosing which framework to trust. Do you follow the prevailing narrative that emphasizes risk at every sign of volatility, or do you evaluate the deeper structural signals shaping long-term demand and innovation. Markets have always rewarded those who can distinguish noise from signal and maintain perspective when sentiment swings from optimism to fear. If you want to make decisions grounded in clarity rather than reaction, then focus on capital flows, institutional behavior, real-world adoption rather than headlines alone. Share this perspective with others who may be reacting emotionally to the current narrative, and continue to seek analysis that goes beyond surface-level commentary. Because in the end, the investors who benefit the most are rarely the ones who panic first, but the ones who understand the larger shift unfolding beneath the noise and position themselves accordingly.